Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 309 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. So good morning, Matt.
Morning, Mark. How are you doing?
Doing well. Dropped Kenzie and Mia off at the airport yesterday because they are going down to visit my mother-in-law. So I am alone in the house for the first time, I think since Mia was born, which is kind of a weird feeling. But when I was saying goodbye to them, and giving them a hug and a kiss before they went through security, I was walking away. And there's a guy in line at security. He looked at me and he goes, "Hey, it's vacation for you, buddy." Which is kind of true. And it's like you look forward to having some alone time, but it's not as, I don't know if you ever feel this way, but it's never as good as it actually sounds.
As glamorous as it sounds.
Yeah. You miss them and you feel like, oh, I'm gonna sleep super well. I didn't sleep great last night, so it always sounds better than it actually is, but.
Well spoken, but you're going to look forward for them to come back.
Yes.
And it's going to be nice. Well, my big news for you is I got my second round of 9 holes in for the year. I know it's mid-July, but this time I scored a 53, baby. 53 in the back 9.
That's great. Yeah, it's coming down, making improvements. So as I'm sure as the kiddos start to get a little bit older, you'll be able to play more and more. But yeah, that's impressive for you. That's a good score.
I'm very proud of that. Thank you.
Very good. Well, before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast for a while now and want to take the next step in your financial journey, I'd encourage you to head to our website, jessupwealthmanagement.com. Matt offers a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at jessupwealthmanagement.com, just click to schedule initial call and select the time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today. As always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from YCharts and as of the market close on July 16th. S&P 500 index up 0.9% for the month and up 6.5% for the year. The Dow Jones Industrial Average up 0.4% for the month and up 4% for the year. The NASDAQ Composite Index up 1.8% for the month and up 7.4% for the year. The Russell 2000 Small Cap Index up 2.4% for the month and flat on the year. And the Vanguard All World Ex United States ETF is down 0.2% for the month and is up 16.9% for the year. 3-month Treasury rate at 4.41%, the 2-year Treasury rate at 3.88%, and the 10-year Treasury rate at 4.46%. Nothing really in terms of big headlines, current events for this week, Matt. I did see a post on X from Ryan Dietrich earlier this morning that he was just highlighting that most of July's gains are made in the first half of the year, and starting today, we transition to the second half of July. And just to point out that, hey, it wouldn't be surprising if we did get a little bit of a pullback here, or stocks did have a little bit of a breather, especially after the strong move off of the April lows, but then also a strong first half of the month of July. If the next 2.5 weeks come with some selling, that shouldn't be much of a surprise to any of us.
I feel that the more that these tariff headlines get recycled, the more and more numb the market is becoming to it. And so I'll be curious to see how that plays out, especially over the next month as well.
Right, right. And then yesterday you had, a report come out that said Trump wants to fire Jay Powell, the head of the Fed, and then a couple hours later, or an hour later, maybe, Trump came out and said, no, I don't want to do that. And markets were kind of bouncing, back and forth between that, but provided some a little bit of volatility yesterday. But moving on to tweets, articles, and research from this week, the first thing I had was a post on X from Nautilus Research. This was back on July 7th. And what they did was they showed what the average seasonality is for the market over the 4-year presidential cycle. And they overlaid that with what it's been up until this point, starting with 2024, because the first year of the presidential election cycle is considered the election year.
Yep.
With this chart, all they're showing is that the trend has been pretty accurate. Now, obviously, the dip earlier this year, or the correction that we had earlier this year in the market, was more severe than what has happened on average. But we have to remember that it's an average. We use seasonality more to see, what the trend is going to be. And, like we talked about earlier this year, it wouldn't have been abnormal to see some selling or some weakness in the first quarter of this year, which we got. But then, as the average seasonality shows, markets tend to rally from Q1, Q2 through the end of the year, and that's what we're seeing so far. And obviously, next year is probably the weakest year out of the entire 4-year cycle, with it being a midterm election year. The average midterm year is down to flat on average, and then the last and final piece of the 4-year election cycle, what we refer to as the pre-election year, tends to be the strongest year out of the entire 4 years. So I just thought it was interesting that even though the percentage changes haven't been totally accurate throughout this 4-year cycle, the trend has been accurate. So I think it just goes to show that using this seasonal data is very helpful.
Plus, Mark, if you went to bed on January 1st and you woke up right now and you looked at those year-to-date numbers, seems like a pretty sleepy year, doesn't it?
Yeah, you'd say not much just happened, right?
Oh my gosh.
So, anyways, moving on to my second topic. This was a blog post from Ben Carlson titled "Not All Stocks Recover Their Losses." This was back at the end of May this year. So he said that Michael Mauboussin had a new research piece out about the drawdowns and recoveries of individual stocks. So what he did was he looked at 6,500 stocks over a 40-year period from 1985 to 2024. And he discovered that the median maximum drawdown was 85%. And the average maximum drawdown for these individual stocks that he looked at was about 81%. And another interesting thing about this is that over half of these stocks, 54%, never managed to recover to their previous peak. So he gave examples of well-known companies like Citigroup, Nike, Walgreens, Intel, Target, Estee Lauder, that they're currently sitting on drawdowns of 87%, 65%, 88%, 73%, 64%, and 82% respectively. And some of those have been in drawdowns from all-time highs for years, and for some it's been decades. So he says to avoid anchoring to past price points, stocks don't have to trade back up to their previous high just because they were there before. The past price level is meaningless, and if the fundamentals of the company or sector have changed, especially. Trends can last much longer in both directions than most investors assume is possible. Emotions can cause prices to detach from fundamentals in a hurry and stay that way for a long time. So I thought that this was really interesting just because, everyone is waiting for that cheap sale or that cheap stock to buy where it's 70% off of its highs. But the reality is when a stock is that far off its highs, half of all stocks never manage to make it back to their peak. And I think that's one of the big misconceptions in our industry is that you should wait for some sort of large sell-off to get into the name. Well, at that point, it's pretty much a coin flip if that name is ever gonna make it back or if it's gonna go bankrupt, because we've seen time and time again where stocks have seemed like a bargain, and people have bought it and it continued to go down 100% for there, and next thing you know, the company is no longer. So, thought that this was a really good piece that put some numbers behind what I've been saying for quite some time now.
Hmm?
So, what are your thoughts here?
It's interesting. I think stealing a phrase from you, Mark, sometimes things are cheap for a reason, and sometimes they're just value traps, right? And just because it was at one price, like you said, at one point in the past, doesn't necessarily mean it's going to get back to there. And let me give an example of a name that's not as relevant today, but was a long time ago. Not a recommendation for or against Pitney Bowes. So before the whole, internet revolution, people were still mailing a lot of stuff, and Pitney Bowes was making a lot of money. We started to get it into the 2000s when you had a lot more electronic communication starting to rise, and a stock like that had a dividend that was a lot more than 5%. Don't quote me on this exactly. It's like 7 to 8% yield at
Wow.
that time. And it's like, well, how can I pass that dividend yield up, Mark? And what do you think eventually happened? The earnings continued to erode to the point where the company couldn't pay that sort of dividend anymore. So people were buying that stock for the income, but ended up losing more on what, Mark? Share price.
Yeah.
And it's like those are the things I think you got to be careful of. Again, I have no idea where their business stands today. I'm just given a story from several decades ago. It's just interesting when I see tidbits like this and people assume it's kind of a guarantee it's going to go back to the high if they just hold it long enough. And just like you've highlighted, that might not be the case.
Yeah, and I think like an example from not too long ago, again, not a recommendation for or against, but Peloton, ticker symbol PTON, it was a pandemic darling, right? And people thought that it was, that company was going to change the health and wellness
Well,
industry.
well,
And next thing just a couple of years after 2020, that stock was 95% plus off of its high, and it still
yeah.
has not recovered yet. So I just think it's a dangerous game sometimes to play when you anchor to a certain price point and say, hey, Peloton's trading at $2 a share. It was at $20 a share, so I'm just going to hold it until it gets back there. You know, it just might not never get back to that point. So
Good piece you highlighted. I like that, Mark.
last thing I had was a more magazine covers from The Economist in May and June, and to be quite honest, it's starting to get exhausting just like reading these things, just with how negative they are or how wrong they are most of the time. So in May, there was a cover of The Economist that had an American flag blowing in the wind, but it had smoke rising from the bottom of the page, and it said American Disorder. And then in June, it said new, untested, and dangerous, a special report on American finance. So, and we know what happened in May and June, Matt. The stock market did great. It continued recovering from the sell-off in April, and once again, the economist got it wrong and continues to get it wrong. So, again, I think this continues to be another really good contrarian indicator. And when the mainstream media starts to get a hold of stories like this, they've already missed it, right? There is no more alpha to squeeze out on whatever direction they're pandering in terms of where the stock market is going. Um, and it's just, yeah, it's exhausting. I'm surprised that, people haven't gotten fired over there yet at The Economist.
I think that what they are trying to do is they are trying to pick, the economics behind it. They're trying to pick headlines that are going to sell the most papers, i.e., the old school version of clickbait, right? And I'm going to start saying this more and more in the podcast, and I'm going to share it with you. Every time the market gets the same headline, it's going to care less and less about it. And I think that is important for investors to remember. And it goes back to my comments a couple minutes ago about what is the recycled headline right now is tariffs. Now that we have the spending and tax bill behind us, now it's the tariff boogeyman is back. And I think that is, the more that they recycle that, the more numb the market's going to come to it.
Yeah, and we saw that, like you were talking about, what was it last week, where Trump announced more tariffs on, copper and steel, and more tariffs on Canada, and the market didn't really flinch over that, right? And so I think that's a really good example of it, where everyone freaked out in April when that happened, but now new tariff announcements and the market action has been relatively muted. So yeah, that's a good point.
Yeah. My first thing this week is going to be an interesting research piece that might give us a tell, Mark, on where we stand within the cycle of this rally or this uptrend. Now, this is a piece that caught my eye from Neil Satie. He posted this on July 14th. And I'll verbalize this for our podcast listeners because it's a really good chart. This will be in our show notes and posted right now for our YouTube viewers. And what Neil did, Mark, is he posted a piece of research. The underlying source here was Deutsche Bank. And Deutsche Bank appears to track 4 different baskets of stocks. And the 4 baskets are what they would call early cycle stocks, mid-cycle stocks, late cycle, and end cycle. And what it appears that Deutsche Bank is attempting to do is have these baskets of these 4 different types of stocks to see how they're performing against each other, to give investors maybe a sense of, in one of those normal uptrends that last multiple quarters, years most likely, where we might be in the overall cycle itself. You tracking with me so far?
Yeah.
So what the research indicates most recently is that of those 4 baskets, the stocks that are doing the best right now are in the early cycle basket. So it's interesting that they are noticing, and now I'm going to read Neil's post, quote, and this is underlying sources, Deutsche Bank, our early cycle basket of stocks have been rallying since April bottom, but tends to outperform in burst and is approaching the top of its usual range. These stocks tend to be volatile, cheap, levered, smaller in size. Conversely, high quality and momentum stocks that had been formerly winning have underperformed. However, the end of early cycle outperformance does not necessarily signal the end of the broader equity rally, but rather rotation into higher quality stocks. So the reason I bring this up, Mark, is if this research is valid, I did not spend a lot of time digging into it, but on a first glance, hey, that could be one of those data points that we are in fact still in an earlier part of this cycle, this uptrend, this rally. Call it what you will. I'll turn it over to you. Thoughts, comments?
Yeah, it's interesting. I'd like to see a little bit more background information and data as to, what groups or what industry sectors, types of stocks are in these early cycle, late cycle, mid cycle, and end cycle groups. But if this data is accurate, I mean, it shows pretty clearly that right before the sell-off in April, the end cycle stocks were performing the best, and the early cycle stocks were performing the worst. And then right after the sell off in April and late April and early May, the early cycle stocks started to outperform the late, mid, and end cycle stocks. So I'd be interested to see how they break these up. So yeah, if you actually could send this to me or do a little digging and send me to a place where I could look into that, I think that would be really interesting.
So I'll get the firm on it. We'll get our resources on it, and then maybe in a future podcast we can report back. Interesting,
Yeah, sure.
isn't it?
Yeah, I like to see how not only how these groups of stocks have performed over the past year, because that's all this is showing, but how this is played out over the past 5, 10, 15, and 20 years.
I'm on this. All right, my next thing is what I call a fluid situation for tariffs. I know I am also a part of recycling this headline, but since clients and listeners, loyal listeners of the podcast, are hearing these headlines, I thought I'd throw it out there. So this illustration will be in our show notes for our traditional podcast listeners. Jen will throw this up for our YouTube viewers. I'm just going to verbalize a couple. So it said, and I quote, as of July 12th, President Trump has announced new tariff rates on dozens of economies and extended the tariff deadline to August 1st. I'll throw out a couple that I'm cherry picking. Brazil goes from 10 to 50%, Canada 25 to 35, the EU 20 to 30, and I'll throw out one more for good measure, Mexico 25 to 30. So reason I'm throwing this out there, again, the more this headline keeps to get recycled, it gets more and more priced into the market. The market becomes numb to it. Just want to throw it out there, okay?
Yeah, and I think, the other thing to note here is some of the tariffs have decreased, right? So from for Sri Lanka, 44% to 30% now is Sri Lanka, and I don't mean to, to talk crap about Sri Lanka, but is that more important than our, trade deals with Canada and Mexico? Probably not, but
sure.
There are a handful that have decreased. Iraq, Bosnia, Libya, Algeria, Bangladesh, Serbia, Cambodia, those have all come down as well. Now, again, those are probably smaller trading partners than some of the larger ones that have continued to go up, but I think it's worth throwing out there that it hasn't all been increases.
What's really interesting for me is over the last week, I've seen these narratives of what I would call old Wall Street trying to justify their wrong views from March and April, how they said that this was going to completely carpet bomb the inflation narrative. And now the new narrative is, well, I guess we really didn't calculate the fact that 70% of US GDP is domestic consumption, and that we were overestimating the potential effects. Doesn't mean they can't show up still. But I found it really interesting that they're trying to circle back on some pretty bad calls from a couple of months ago. All right,
yeah,
number 3.
and just because you brought this up, I gotta just bring it up now. I was gonna wait to to use this next week or in the next couple of weeks, but I was reading an article from Ryan Dietrich today, and he was talking about Wall Street forecasts that haven't fully recovered from the tariff turmoil yet.
Oh,
So
bring it.
we won't share the chart. I'll just talk about the chart, but it shows a chart that tells you what like Wall Street analyst forecasts were for the S&P 500 at the beginning of the year, at the tariff reaction, and then their latest forecast. And it's just consistently wrong, wrong, wrong. And I think when you have people that adjust their forecasts immediately when there's a negative reaction or sell off in the market, you should be looking at that really closely, because if people are willing to adjust their forecast or their estimates based on a geopolitical event or a market event, there's so many unknowns that go into it. So, when I see Wall Street analysts, drop their S&P 500 year-end forecast after the tariff announcement, but then they raise it again after the market has recovered, it's like, what are you doing, man? Like,
Yeah.
again,
I
just
I don't think it's about being right. I think it's about being first.
Yeah, I just don't, again, I don't understand the purpose of this. It continues to be, in my opinion, a situation where it does more harm than good, because, you're just like reacting throughout the year to like what is happening. So why even have an S&P 500 price target, year-end price target in the beginning of the year? It makes no sense. So I just wanted to bring that up. I was going to save it for a later time, but with what you were talking about, I think it made sense.
All right, I got a little just because you're on your soapbox, I got to press a little harder. I think we should do a dollar gentleman's bet on an over under on the S&P. I'll give you a week to think about it. Okay. And when we're on the podcast again next, I'm not sure if it's next week or the week after. I'm gonna pick a number. You're gonna pick a number. We'll meld it for the average, and then I gotta force you to pick the over or the under. I'll take the opposite, and then you and I have the classic $1 gentleman's bet on this.
Yeah, I agree. I think that's a great idea. And again, just to close this topic off, my 2-year-old daughter has just as good a chance as picking the S&P 500 year-end price target as all these fancy Wall Street analysts. I'm just going to throw that out there.
Correction now. You're not going to pick the over or under. We're going to have your daughter pick the over or under.
Right.
I'm going to take the opposite, and I'm in for $1.
Yeah, we'll print out a chart of the S&P 500 and have her point to a level on the chart, and that'll be what it is.
I'm in. Done. All right. I know our listeners and viewers are going to love this one. Talking about what you just said. Not my next thing. So 2 more quick things. Seeing cracks within real estate. I just want to highlight this. This was a post by Bravo's Research. The date on this was through June, so end of June. Underlying source, Bloomberg and the National Bureau of Economic Research and Brazos Research. What they're illustrating here is the delinquency rate of multifamily housing. And the underlying source, again, Freddie Mac's serious delinquency rates for multifamily housing. And the data set goes back over 20 years, and we're almost approaching this 0.5% level. And the reason that it's highlighted is that through the lens of history, once it gets over this level, you tend to be near recessions. And I think it's just really interesting to see kind of the cracks in multifamily housing. Again, is this spelling concern across all of real estate? No, but you are starting to see supplies starting to stack up in some states. I'll name a couple: Florida, Texas. Now you're starting to see some delinquency rates stack up. I think that one thing that could help turn around this trend is if you start to see lower interest rates. Now, is that going to happen? How quick? That's an entire podcast within itself. Just want to throw it out there. Want to give some reference points, seeing some cracks. Just be aware, listeners and viewers. Before I go on, any comments, Mark, on that?
Yeah, just to clarify, so we're talking about like people or companies that own multifamily housing units.
The loans against them, sir.
The loans against them. Okay. Yeah. Okay. Yep. Yeah. No, I don't have anything to add. It's an interesting piece, and interesting how far we've come since just before 2020.
Well, you might start to see more foreclosures on multifamily housing.
Yeah. Yeah.
All right. My last piece is interesting legislation about stable coins. Okay. Now, this is a post that I saw on July 12th that is in regards to the Genius Act that was passed. So a couple provisions in this I just want to throw out there because, again, this is why you listen to the Independent Advisors podcast. We're telling you about the headlines that you're going to hear about over the next, not only couple of quarters, probably the next couple of years. You're going to hear the term stablecoin more and more often. And this legislation, I think, could be one of those really pivotal pieces that propels this area of financial services. So
yeah, and I think really quick before we get into this, Matt,
yep.
I just used ChatGPT to explain stablecoins to people. Unless you're going to do that.
No, sir. I want you in on this.
So, according to ChatGPT, again, I just did this on the fly here. Stablecoins are a type of cryptocurrency designed to be stable in price. They don't bounce up and down like Bitcoin or Ethereum. Think of a stable coin like a digital dollar. Each stable coin is usually tied to something like one US dollar. So one stable coin equals one US dollar almost all the time. They're often backed by real assets such as cash or bonds sitting in a bank, and people use them to send money quickly without using a bank. They can trade crypto in a wallet without moving money back to real cash. So this is what we're talking about when we're talking about stable coins here.
Thank you, Mark. That's
Yeah.
very helpful. So with this legislation, again, a part of the Genius Act, I'll read a couple of provisions and then I'll get your reaction. First provision, what was called the Fed backstop access for stable coin reserves. Bloomberg reported from senior Treasury officials at the June 18th Milken meeting that stable coins would receive the same liquidity treatment as money market funds. This fundamentally changes the risk profile. Provision number 2, $200 tax exempt for retail stablecoin payments. A leaked Treasury slide deck shows transactions that are $200 would be exempt from capital gains reporting. Okay. So, and then this is what the poster puts: smart policy that removes the primary friction preventing mainstream consumer adoption. Number 3, this one's very important. Bankruptcy priority for stablecoin holders. The bill grants stablecoin holders senior status over all other creditors in bankruptcy proceedings. This makes digital dollars, I'm going to use the word potentially, safer than traditional bank deposits. No other country offers this level of protection, this post was saying. And then current market breakdown, I'll name off a couple, not a recommendation for or against any of these. Tether, which is offshore, 159 billion in their stable coins. Circle, US regulated, 63 billion. PayPal, over 10 billion. And the regulatory framework has established 100% reserves in Fed deposits or Treasury bills, 90 days or less, quarterly gap audits with 45-day reporting, settlement of T+2 redemption guarantee, and criminal penalties, 10 years in prison, 1 million fines per violation. They have a period of time. If they want to do business in the US, they have to onshore the assets and they're going to be regulated. So that's kind of my main point is I think you might see more adoption of these high yield, let's say online savings accounts. They're about to get some competition over the next, let's say 2, 3, 4 years. I think you could start to see advertisements with this stuff in a couple of years. You heard it here first. And I think you're going to see more on this topic. It is far from gone. Mark.
Yeah, and I think, when you were going through all this, what I think is important for me and important for everyone else to understand is the reason why stable coins gained this huge popularity over the past 5 years is that they could offer interest rates that you could not get in a traditional money market account or a short-term government bond, right? So you had these stable coins, and for people that are listening, I'm doing my quote fingers, that didn't really move in value, but they were paying people upwards of 12 to 13% to just have your money sitting in there.
Yep.
But what happened, which if people have forgotten by now, is that some of these crypto firms went belly up.
Yeah.
And what happened to people that had money in these stable coins? They lost it, right? And there's been lawsuits and people trying to recoup funds, but I have friends that have only been able to recoup, 15 to 20% of what they've had in stable coins. And everyone thought it was the best deal in the world because everyone thought that there was no risk and they were getting paid 12 to 13%. And like I said, like we say a lot on this podcast, if it sounds too good to be true, it usually is.
Yes.
So I would imagine going forward in the future, those interest rates that you're getting paid to hold these stable coins are not going to be as high. But now it gives it some real validity to this industry that it is going to be an investment that's backed. And I think you're right. I think this is going to be another competitor to a lot of money market funds and stabler investments out there going forward in the future.
One last comment since you said all that. I'm going to play, just so all listeners and viewers hear me say this, I'm going to run a quick scenario past everyone. I get a call tomorrow, someone listened to the podcast, and they say to me, Matt, should I be taking a look at these stable coins? Here's my reaction to it. It says here that offshore issuers targeting U.S. users must relocate within 12 months or face criminal penalties starting on day 366. So if it's me, I personally, just the conservative side of me, I'd stay out of this for the most part. Let the dust settle, let the regulatory environment really get there. Then you can start doing due diligence on it. But just so I'm heard on this, I don't want people rushing out and doing a lot of stuff in this area. That's my kind of official stance, just so it's clear.
Yeah. No, I totally agree. I mean, it's already come a long way from a regulatory standpoint. So I'm sure over the next 5 to 10 years, we're going to have even some more significant changes. So
yeah, do your homework, listeners. But this is something I would wait on. Just letting you know this is on the horizon. My 2 cents.
Well, I think we're going to leave it there for the week, Matt. Just one other thing to note is we are in kind of the beginning of earnings season right now. So we had a lot of the big banks report earlier this week, and over the next, I would say, month, there's going to be a slew of earnings reports and news coming out. So again, like we always say, disclaimer that markets might be a little bit more volatile over the next couple of weeks as companies continue to report how they did in the previous quarter. But other than that, Matt, anything else you want to leave with listeners?
That Fed meeting's coming up on July 30th, right? There's going to be a lot of eyes and ears on that. I know we talked a little bit about that in the last podcast. Stay aware of that, listeners and viewers. I think there'll be definitely some headlines surrounding that day.
Yeah. Thank you for that reminder. And thank you, everyone, for listening to episode 309 of the Independent Advisors podcast. We will be back with you next week for episode 310.
Great episode, Mark. We'll see everyone next week.
Thank you for listening to the Independent Advisors podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.